Welcome to It's Possible Podcast. This is where we help entrepreneurs and families to save money, to plan their retirement, and retire without financial stress and pass on wealth to the next generation. Today, I have with me my guy, Mo. Mo, please take a minute, introduce yourself, and tell the people what you have for them today, please.
Hi, my name is Mo Fenor. What I do is I take renters and show them how they can become homeowners. Working at just a few items, I can take someone who has been renting for years and show them that it's possible for them to become homeowners and participate in the American dream.
Powerful, man. And what you just said here, man, it is something that I have heard so many times, where people that have been here in this country for so many years and they still renting, because sometimes it's because of fear. They think that they would not qualify for a home. Now you say that you can take people who've been renting for a long time and make them qualify for a home.
The reality is there are more than 40% of renters actually qualify for a home, but they never take the chance to apply, never take the chance to speak with a mortgage professional because they're too afraid. Oftentimes they think that their credit is too low and they won't qualify. But if they take the time to speak with someone who's able and understands the system, understands the mortgage process, they'll learn that they actually qualify, and within months, but they can possibly be in the home of their dream.
Wow.
Just by taking the time to talk with a mortgage professional.
This is good. This is good. And I'll tell you why. I went to a church once, and the guy was saying that he came to give his testimony. And the testimony was, he was driving with Lyft, I believe. He was not making a lot of money driving with Lyft. And he said he wanted to buy a house. And he went to the place and found a house that he liked. Then he spoke with someone, maybe a guy like you, and they told him that he would qualify for the home. After 2 months, he was inside of the home with really low income. And after he said that, I say, man, I know so many people who've been renting for a long time. They are only afraid to check to see if they qualify for a home. And now that you're saying it, it makes me believe this is possible.
You know, oftentimes people think that the mortgage company or a mortgage lender is able to discriminate based on their source of income. As long as you're earning money and it's legal, loan lenders cannot discriminate on your source of income. It's illegal.
Okay.
The law doesn't allow it. So if you're earning an income and perhaps you think that your credit score is too low, I would advise you not to sit on the sidelines. What happens when people sit on the sideline is that interest rates start to increase. We never can tell whether the interest rate is going to go up or down. So it doesn't make sense for us to sit on the sideline.
Okay.
But what we know, though, is that oftentimes, and what we've seen over the last few years, is that housing prices have been going up. So the longer that you sit on the sideline, the more you place yourself out of position to be able to buy a home.
Now, tell me this. What are the things that the lender or the bank look at to determine if the person qualifies or not?
So there are four things that a lender will look for. And they call it the 4 C's. They're looking at your credit. They're looking at your capacity, which is, do you make enough to be able to afford to make your monthly payments? They're looking at your capital. Do you have enough money in reserve in order to pay closing costs or a down payment? And they're looking at the collateral, which is the property that you're interested in purchasing. But what I'd like to say to borrowers, instead of trying to remember the 4 C's, let's narrow it down to 3 things. Let's call it CIA: your credit, your income, and your assets. Work on those things. Your credit is an important key to making moves in this country.
Okay, wait. Too much, man. Come on. They're going to just watch the video and go buy their home. What's up with this? Yeah, okay. No, I just want everybody to understand we're going to go step by step so that everybody understand exactly what to do. So you say they look at your credit, your capacity, your capital, your, what's the other C?
Collateral.
Your collateral. These are the things they look at.
Right.
The collateral is not, you're not producing the collateral because it's the house you're going to buy.
That's the house. Exactly.
The credit, what is the credit somebody may have to qualify?
So most of the time, people don't take the time to review their credit report.
Mm-hmm.
So they don't know what their credit score is. But a lender is looking at your FICO score.
Mm-hmm.
And the way that the FICO score model works is that 35% accounts for your payment history.
Okay.
Are you making your payments on time?
Mm.
They're looking at the credit history.
Mm-hmm.
They're looking at the age of the accounts
Mhm.
that you have. So the age, how long have you had credit?
Okay.
They're looking at the balances. If your balances are too high,
Mhm.
that may be a negative. They're looking at recent open accounts. Now,
Mhm.
in the short term, recent open accounts will have a negative impact on your credit score. But in the long term, it would balance out. They're also looking at the types of credit. Is it
Okay.
revolving or installment types of credit?
So let me stop right here. Like revolving, do you have credit cards? Do you have a car on your credit? Right?
Hmm.
So these are the things, like when we say revolving, we're talking about credit cards, right?
Exactly.
Okay.
Revolving would be an example of, credit cards would be an example of revolving
Okay.
credit. Then you have the installment types. Your car payment would be
Car payment.
installment.
Mhm.
Your mortgage is an
Mhm.
example of an installment type of credit.
Okay.
So they're looking at the types of the credit mix, the types of credit that you're holding.
Okay.
All those things account for your FICO score.
Gotcha. So if you're thinking about buying a house, what you would need to do is to, get yourself some credit cards.
If you don't have any established credit,
Mm-hmm.
then it makes sense to get a credit card and establish credit,
Okay.
right? And once you have established credit and you have a history of making on-time payments. Now remember, anything after 30 days is
Mhm.
going to be reported late.
Late. Okay.
So most of the time, you have a grace period before the creditor starts charging you late fees.
Mm-hmm.
But beyond the late fees, after that grace period, if you're late and it's 30
Mhm.
days plus,
Mm-hmm.
they're required to report to the credit agencies showing that you're late. And that's a
Yeah.
huge negative on your credit report.
So late payments is something that we should avoid.
We should definitely avoid
Definitely.
that. And one of the things that causes late payments is people do not open their mail. A lot of folks they rather leave the mail. They're so scared of the debt
Yeah.
that they don't open it, but it's still there. And what happens is you start accumulating late fees
Mhm.
and you start accumulating negative reports on your credit.
That's a good thing. So if you're trying to buy a house or you have not even thinking about buying a house, now that Mo is telling you that it's possible, so you got to start working on your credit.
That's the very first thing that you start to look at.
Okay.
You're able to get a free credit report every year. Go in to the credit agencies, download your report, and take a look at all the negative items on your report. Most of them are easy to address. For instance, if you have a collection, you've had a collection and you've paid it off, you can actually call the creditor and say, can you please remove that off my credit report?
Okay.
So you can often do things that will allow your credit score to improve
Mhm.
if you're taking the steps to manage that credit properly.
Okay. All right. This is a master class right here already. So manage your credit. Make sure your credit is at the level where it has to be, so that the late payments. Avoid to have late payments on your on your credit report, and then it's possible that you can get a house.
Avoid late payments. Make sure that You're paying on time. Don't open too many accounts. Now, when you go to the grocery store or any one of these department stores, they're often offering you credit. If you're trying to purchase a home and you're already in the process and you go to the grocery store, you go to the department store, and they offer you credit, please decline. Do not accept it. Because once you're in that process and you add a new line of credit to your report or to your account, what that does is it has the potential to lower your credit score, because once you're in the process, the underwriter is going to take another look at your credit to see if you've added anything. And those the more
inquiries, right?
Right. So the more credit that you have, and what it shows is, even though you're managing it, if you're just aimlessly accepting cards, accepting all types of things, and you're not making payments on time, you're looking riskier to the lender. You want to make sure that when the lender looks at you, that they see you as a good risk, a risk where you're the type of person that makes on-time payments and that's serious about paying off your debts. That makes you attractive to the lender.
I see. So there is one more thing that I may be thinking about is the inquiries. Now, sometimes you go buy a car. You want to buy a car, you go to the dealership so that they can give you credit to buy the car. And then they send you credit to everybody. Like you have like 1,000 inquiries coming out because you wanted to buy a car.
So what happens is, it happens when you're trying to get a mortgage. Let's say you come to me and I run your credit, and I do a hard pull on your credit. There are lenders who buy leads where as soon as they can see they're buying leads from the credit agencies. As soon as they see that your credit runs, they see that you're interested in obtaining credit, and everyone starts to call you. So if I'm working with you, I would let you know that this has the potential to happen. Disregard those calls.
Okay.
You and I are working together. Let's behave as if nothing happened.
Okay.
And do not accept to even take the calls from those folks.
And stay focused.
Stay focused on what we're trying to achieve.
That's good. So, all right. So we're in the process here of taking someone who's been renting for a long time. Now they want to buy a house, and you're guiding them through the process until they buy the house. So the first thing is they got to check their credit. The second thing,
check your credit.
All right. So, and you were talking about the CIA.
Right.
So let's talk about CIA.
So CIA, I say CIA because it's easy for us to remember than the 4 C's.
Okay.
Right. So your credit, C for your credit, and then your income. You want to make sure that you're able to afford anything that you're going to get into when it comes to a mortgage, even purchasing a car, that you can afford it. So it makes sense to kind of take assessment of your income.
Okay.
When a lender is looking at your income, they're looking at your gross. And we know that your gross is not what you bring home. So consider what you have going on before you even get into the mortgage. Take a look at what you're paying for rent and really assess what you can truly afford. Even before you go to the mortgage professional, it makes sense for you to assess, to say, based on my income, what do I believe I can afford? And the lender, again, is looking at your gross, not taking into account insurance, utilities, and so forth. So kind of take a look at whether you're meeting your obligations before you even meet with the mortgage professional. Okay.
That's good.
So that's the I. Take a look at your income. And then have you been saving money? Do you have a savings account? Do you have an investment account? The lender's going to be looking at your capital. Are you able to make a down payment? Are you able to meet the requirements of a closing cost?
Okay.
Take a look at your capital, what you have saved, what you have in investment accounts to assess whether you can do that, even prior to meeting with a mortgage professional. It makes sense for us to take a look ourselves and determine where we are, and then seek the guidance of a mortgage professional.
That's good. So, all right, buying a home, your credit, income, and asset.
Right.
So you need to have some money saved somewhere, for closing costs and things like that.
Right.
Right? Okay. So what else do people need to know?
So the other C that we talked about is collateral.
Mm-hmm.
Now, there are different mortgage programs that fit every situation.
Okay.
The collateral comes into play depending on the program that we're approved for.
Okay.
There are certain limits and restrictions on the type of home or the type of property
Mm-hmm.
each program allows based on their guidelines.
Talk to me about some of the programs.
So there are two sets of categories of mortgage programs.
Mm-hmm.
What we call qualified mortgages,
Mm-hmm.
non-qualified mortgages, QM, non-QM. The qualified mortgages, one of the key features is that it's fully amortized. What that means is you have a fixed monthly payment
Mm-hmm.
that will gradually pay down the loan until maturity.
Okay.
Some of the non-QM products, the non-qualified products, they may be interest only. So you may have an interest only loan where you're never hitting the principal.
Hmm.
But qualified mortgages require that you pay down principal until the mature and pay off the loan at maturity.
So you would never finish paying the house.
Right. But that doesn't mean it's a bad program because it's a tool. Again, all these mortgage programs are tools, and it fits.
Okay.
It depends on the situation, right? There may be situations where you're not interested in paying down the principal and just interest because it fits your situation.
Really?
Again, it's a tool, right?
I don't know why would someone do something like that? You never finish paying the house. It's like you're renting.
Well, so one example would be, let's say I'm a real estate investor
Okay.
and I want to purchase a home, and just for rent, for example,
Mhm.
right? So I'm renting the home. The monthly payment that I'm paying on the home is less than what I'm renting it for.
Okay.
And eventually, at some point, I either want to refinance it or sell it.
Okay.
So I'm not interested in bringing down the principal. I believe that the value of the property will appreciate,
Ooh, okay.
and I don't want to spend paying down principal if I don't need to.
That's good. Let me try to understand that. So you buy the house, you take the loan,
Mm-hmm.
then you say, okay, here's what I'm going to do. I'm going to only pay towards the interest.
Right.
Your monthly payment is less then.
My monthly payments is less than.
If you were
The
going
rent.
to pay towards the principal.
Right. My monthly payments is less. Yes.
Okay.
Mhm.
Now less. And then you rent that house to somebody else.
Right.
That person is paying, for example, $2,000
Mhm.
and you're paying the bank $1,500.
Right.
So now you say, okay, cool. I'm gonna sell the house.
Right. So after some time, I decide to sell the house. It appreciated.
That's a play.
So that's a specific. That's a product that's specific to a certain goal, right? A certain
Okay.
situation. So there are qualified loans that are adjustable rate loans, for example,
Mhm.
and that product is good for certain situations. Now, I've seen examples of when people got into those types of loans and didn't understand what they were getting into,
Mhm.
where the interest rate shot up on them and their monthly payment ballooned to an unexpected amount because they didn't know what they were purchasing.
Yeah.
But in the right hand, in the right situation, let's say I want to purchase a home and I'm only planning on being there for 5 years.
Yeah.
And I get an adjustable rate loan that's supposed to, the rate will change in 5 years.
Mm-hmm.
I plan on leaving
Yeah.
in the fourth year. But because it's an adjustable rate, we're going to start with a teaser rate that's lower
Mm-hmm.
than what the market rate is. So I'm coming in at a lower rate, I don't plan on being there for a long time.
Okay.
It fits my situation because I'm going to sell the house and move away before the rate is scheduled to change.
Okay. Now, when you sell the house, is that new buyer responsible to pay the rate, or they can come and do the same play?
Well, once you sell the house, you pay off that loan. So that loan no longer exists,
That's powerful.
right?
Yeah.
So the person purchasing it, it depends on their situation,
Yeah.
right? So if it's being sold to a first-time home buyer and they have their situation is that their credit is not as high as they would like it to be.
Mm-hmm.
So an FHA loan would be a product that would fit that person's situation.
Okay.
First-time home buyer, the credit score restrictions are lower,
Mm-hmm.
which means they can come in at a lower credit score. And the FHA loan is also a government-backed product
Okay.
where there is mortgage insurance to protect the lender.
Mm-hmm.
So there are less restrictions, more wiggle room for somebody who's coming in with less income and lower credit score.
Mm.
So what that does is it allows that person to come in, first-time home buyer. They can build equity. Now they have to pay mortgage insurance because that's one of the requirements of an
Okay.
FHA loan. But they come in and they become a homeowner, and after a few years accumulating wealth, accumulating equity,
Mm-hmm.
they can, when they make their purchase their second home, they can have a more significant down payment. Their credit score may have improved, so they can
Okay.
qualify for a conventional loan,
Mm-hmm.
which is less restrictive when it comes to the property type that they can own, the type of home,
Okay.
right? And they may not have mortgage insurance depending if they're able to make 20% down.
Mm-hmm.
So anytime you make a less than 20% down on a conventional loan, you're
They
paying
make
mortgage.
you pay mortgage insurance.
You're required to pay
I
mortgage
see.
insurance. And it's
Okay.
on a conventional loan, it's private mortgage insurance.
Mhm.
On an FHA loan, you're paying mortgage insurance, but it's
Government backed.
backed.
That's good.
So each mortgage product is useful for your situation.
Mm-hmm.
And when you speak with a mortgage professional, they should take the time to hear you out. What is your situation? Right? I've had folks come to me and ask, should I refinance?
Mm-hmm.
That's a good question, but it's not always, the answer is not always yes. It depends on your situation.
Okay.
What are you trying to refinance for? There are folks who say, should I get a home equity loan? Should I
Mhm.
get a HELOC, a home equity line of credit?
Yeah.
What problem are you trying to solve? And when you come into a mortgage professional's office, you explain your situation. Let me hear your scenario.
Mm-hmm.
What is it that you're trying to solve? If you're a renter and you want to get into a home, let me hear your situation. What type of home are you looking to get?
Mhm.
What's your credit situation? What's your income situation? Let's talk about it and come up with a plan that fits your scenario.
Okay. Yeah, I heard this home equity line of credit a lot. Like people say, okay, I'm just going to have a line of credit in my home. They take the money, do whatever they want to do with it.
Mm-hmm.
And what happened after that?
So, the way that the home equity line of credit works is that you're not taking a lump sum out.
Mm-hmm.
You're able to draw on certain amounts. So let's say the total amount is $100,000.
Okay.
And this month you take out $10,000.
Mm-hmm.
You pay interest on that. So every time you draw, you're going to pay interest based on the outstanding balance, the draw
Okay.
amount
Okay.
that you pull from it. But it's a line of credit. But what it also does, it does create a lien on your property. It creates a second lien on your
A
property.
second one.
Right.
I see.
But if you were to refinance, for example, then you would still have one lien on your property. But when you take out a home equity loan or a home equity line of credit,
Mhm.
and you start to draw on it, you're creating a second lien on that property.
Got to be careful with that.
Well, again, it's a tool,
Yeah.
and just like any tool, you want to make sure that if you're trying to nail in, you have a nail, you're trying to put it through the wall, you want to use a hammer. Make sure it's a hammer,
And not your finger.
and not your finger, and not a sledgehammer too.
Yeah.
Just use the right tool for the right situation.
Gotcha. That's good, man. This is powerful. So, buying a home. Let's go back then.
Okay.
Buying a home, you check your credit, make sure you have some income, right? You have some money saved for you to pay for the closing costs, things like that. So this is on point, right?
Okay.
The person say, okay, I have this already. What is the next step?
So you go through the mortgage professional, you lay out the situation.
Mm-hmm.
You start the application process. What will happen is the mortgage professional will take your information,
Okay.
give you a pre-approval letter if it's for a purchase.
Mm-hmm.
With that letter, you're able to go to your real estate agent and say, look, I have proof that I have backing,
Okay.
that I'm prepared to make a purchase. And that real estate agent will take that letter and start to take you shopping
Mm-hmm.
for a home. And when they put down an offer, that offer will stick because the seller also sees that you have backing.
Okay.
Now, again, when you fill out the application, the mortgage professional is looking at 6 things in order to call it a full application.
Mm-hmm.
Your name, your income, Social Security. They're looking at the address. They want to know the address of the property.
Okay.
You have a contract on the property. They want the address, an estimated value of that property, and they're also looking at the loan amount.
Okay.
So once you have those 6 things in, you have pretty much a full application. You start submitting your pay stubs,
Mm-hmm.
your bank statements to show that you have assets.
Okay.
You start submitting those types of documents, and then what happens is it'll go from working exclusively with the loan officer. The file will go through the processor,
Mm-hmm.
and then eventually to the underwriter. The process is going to make sure that all your documents are in, everything that's needed. The underwriter will start evaluating that application,
Mm-hmm.
taking a risk assessment, and throughout the process, they're going to be verifying whether everything that you've provided is legitimate.
It's okay.
And they want to work through that process to final approve the loan so that you can go to closing.
So that means you may have a pre-approval letter and you went check the house, but you're still not qualified for the loan.
So let's say you didn't provide correct information.
Okay.
Some of the information that you provided weren't verifiable.
Mm-hmm.
Now, there are cases where, let's say you have, strange things happen where you have a large deposit on one of your account.
Okay.
And that looks suspicious. They're going to want to know what happened. They look at your bank statements, they're seeing your pay is being deposited regularly,
Mm-hmm.
and then out of nowhere they see a $20,000 deposit.
Yeah.
That requires an explanation.
Why do they want to know where the money's coming from?
Well, so the source of your funds have to be verifiable,
Oh, okay.
right? So, there's so much fraud out there.
Mm-hmm.
And the more fraud that there is, the more risk that's involved in the
Okay.
process. So they want to make sure that everything that you're providing is true
Okay.
to eliminate fraud in the process. Yeah.
And does that have to do also with anti-money laundering?
Right, exactly.
Okay.
All of that, that's all related. They want to make
Okay.
sure that all the source of income is verifiable,
Mm-hmm.
because there are so many people out there that are trying to clean money.
Yeah, okay.
right? And they just want to make sure that you're not involved in that. Because
So let me ask you this before you go further. I'm sorry. How long do you need to have that money in your account? So that means if you have $20,000 that comes in your account, would that disqualify you, or how long do you need to have that money in your account for that money to be qualified?
I'm trying to recall the exact date, how long it would have to be, but I don't recall exactly how seasoned it would be at the moment. But what I will say is that if you're able to supply a letter, an explanation that makes sense, and that explanation is legit and is verifiable, then it'll be accepted.
Okay.
Now there is a seasoning period for having funds in your account, and it depends on the program as well, the loan program.
Okay.
So the idea is that you want to make sure that whatever you have in your account, you're able to find to provide a legitimate reason for that money being in your account.
Okay, that's good. So you have your credit, you have a CIA, credit asset, income asset, right? So you talk to someone like you,
right,
and then you give them a letter, so they can start shopping.
Right.
Right. Go out there and find the house they want. They get you proper information, right? So the income, everything is correct. Now, what is the next step? So you say the underwriter is going to check. So okay, that's in the back end. So now, when they qualify for the house, how does that look like?
So, we didn't touch on the interest rate.
Okay.
Right?
Okay.
We'll come back. I'll come back to that question. I want to touch on the interest rate and just make a key point. We often hear that interest rates are high, right? Or interest rates are this. There's an average interest rate. Understand that when you come in to put in an application, that you're not the average, right? Your credit score impacts the interest rate that you get.
Okay.
The property type will impact the credit score.
Oh, really?
The interest. Because, for instance, a single family home, detached home is considered less risky than perhaps a condo.
Oh.
Right? So that's going to come into play. And then the when it comes to the collateral, the loan to value, right? So if the higher the loan to value is, right, the higher the interest rate is
okay.
Right? So all these things kind of matter. Now, going back to what happens after you put in your application, it goes to underwriting, you've been final approved for the loan. You're going to sit at the closing table.
Okay.
You sit at the closing table. You're going to sign a lot of documents, but there are 3 key documents that you're going to sign. You're going to sign the note.
Okay.
Now, the note details you. The note is the IOU, right? It details the interest rate, the loan amount, and the terms of repaying the loan.
Wait, when you say IOU, is it like the letter IOU, or just a phrase IOU?
The phrase IOU.
Okay.
So if I borrow some money from you and you and I sign a document and you take it, it's me admitting that I owe you something.
Okay.
Right? So the note is the IOU, like you're admitting to me, and you and I agree that you owe me.
Okay.
So that's essentially what it is. So that's what the note details, the terms of the loan, the repayment schedule, and so forth, and the interest rate. Then there is the security instrument, which could be the mortgage, depending on the state, the mortgage or a deed of trust. Then the deed, right? The deed is what actually transfers the ownership of the property from the previous owner to you. Once you sign those documents, the settlement agent will start sending the funds to where they need to be. You've come to the table with your closing costs, right? You're able to meet that. They're going to deduct the down payment on the money that you have to pay at the closing table, and all the funds get sent to the right parties. Now, because I have experience beyond the closing table, I know what happens after that.
Okay.
Right. So once your loan closes, what's going on behind the scene is immediately after your loan closed, in most cases, if you're dealing with an independent mortgage company, is that loan is being sold to another
They
party.
sell it.
Right.
So why do they sell the loan?
Okay. It's very important. And the one key point that we should all understand, that when you take out a mortgage, most mortgages, about 80% of home purchases are backed by a mortgage.
Okay.
Right?
Yeah.
Roughly 80%. I think after post-COVID, it's a little less than 80%. But most homes are purchased with a mortgage. The mortgage company wants to be able to continue lending to other borrowers.
Yeah.
So when they sell the loan, it gives them funds to continue lending. What I think we all should understand and keep in mind is that when you purchase a home with a mortgage, you're not by yourself, because there is a massive industry. As a matter of fact, the entire economy is dependent on you. They want you to succeed because there are investors that are purchasing those mortgages, and they're relying on them for folks that invest in their entity. So you not only it's not only important for you, but it's important for the U.S. economy. It's important for the housing industry. It's important for even your neighbor.
But is that legal for them? They don't even tell you anything before they sell it to somebody else.
So think of it this way. If you open your window and you look outside, everything that's outside is sitting on someone's balance sheet as a receivable.
Okay.
What that means is that someone has extended credit to you to make a purchase, and it's an asset to that person.
Yeah.
And because it's an asset, they can sell it, right? And the whole system is based on putting liquidity and allowing in the system to allow banks to continue to do what they do. So what happens is the loan closes. Let's say you have a loan for $100,000.
Yeah.
And it closes and the bank sells it. Now the bank has another $100,000 to lend to the next borrower.
But they won't sell it for $100,000.
No, they're
gonna make some profit.
It's an asset, right?
Yeah.
So they're gonna get a premium for making that sale. And sometimes, we often think that the bank is always winning. There's sometimes when there is a $100,000 loan, because of the interest rate, right? Let's say the market interest rate has gone up, and the interest rate that you close that is lower, the bank can't sell it for $100,000. They may sell it for 98 cents on the dollar. So there is a loss. There's risk throughout the system.
Okay.
Right? And the whole process is let's limit risk. But again, the reason they sell it is so that they can continue doing what they do, which is to lend money to borrowers to purchase homes.
But how did they make money though? Because if they lend you $200,000, you buy the house, then that loan, how much money they make before they sell it?
Well, there's a premium, and it's going to depend on another. So the investors that are purchasing those loans, they have their own set of criteria that would dictate how much they're going to pay for that. So they're going to look at, again, and it goes back to, let's look at the quality of the loan. Let's look at the borrower's credit score. Let's look at the borrower's debt to income ratio. We didn't really talk about that. The borrower's debt to income ratio.
Okay.
Let's look at the loan to value. And based on all those things, throughout the process, they're going to discount that and then pay for pay a premium for it, but it might be less than what they would pay for someone with top credit score, low.
So it seems like the quality
Of the loan.
Gotcha.
Right, and there are different entities different investors that will purchase those loans.
Okay. Man, that's good, man. I feel that I can just go to. Is there an exam you can take? I can just go take a test right now, man. I'll pass. Yo, man, that's a lot of things I didn't know about this industry, man. Buying a home.
The industry is so important to the U.S. economy. Not only is it allowing folks to achieve their dreams of home ownership, but it does much more than that. It supports the economy. It not only U.S. investors, but investors throughout the world are investing in homeowners in the U.S. And so the way that I would look at it, and the way that I advise people to look at it, you're not alone, because a lot of people are betting on your success. They're betting on you being able to make those monthly payments and pay off your mortgage, because
so that they can get paid.
Yeah, essentially.
That's good. So what advice would you give someone right now who's watching and they say, man, I don't think I would qualify for a home? What would you tell them?
I would say, again, take a look at your CIA. Get your credit report. Look to see if there's anything on your credit report that might appear negative to a lender. Think about anybody who wants to invest in you, for example. If they look at your credit report, would they consider you a good investment? Because, again, we're assessing risk. Once you get your credit report, you look at it, you can determine whether there are things that are incorrect there that you want to address, and you want to send dispute letters to the bureaus to kind of get those things off. But speak with a mortgage professional. Don't be afraid to go out there and just explain your scenario. Never think that there's no way I'm going to qualify, therefore I'm going to sit on the sideline. Go out there and speak with a mortgage professional. And if you haven't pulled your credit report, they can work with you and say, well, let's look at it. Let's see what we can do to improve your credit. Even if you won't qualify now, let's work so that you can qualify in 6 months. That's what I would say to someone who's sitting on the sideline. And let's, again, going back to CIA, let's take a look at your income. Could you possibly be earning more? Are there things that you can do to earn more? Sometimes folks stay in the same job because it's comfortable, but if they change jobs doing the same thing that they've been doing, they may be able to kind of earn more than what they're earning at their current job. So look at your income. Look at all the sources of income that's available to you. Again, the mortgage company, lenders cannot discriminate on sources of income if it's legal. And then look at your capital. Start saving. Making sure that you have something set aside for you, even if you're unable to make your down payment, but you can pay your closing costs. Now, there are programs out there that are called down payment assistance programs that will help you with your down payment. FHA loans allow that.
Okay.
They also allow gifts.
Oh, okay.
So a family member can gift you the down payment, but save some funds for your closing costs and have some money in reserve in case you're not able to work for 2 months. You can continue to make your mortgage payments. And
buy a house that has how do you call that? The under the house. I forgot.
There is
no, you know what I'm talking about is
where you can rent it.
The basement. Buy a house with a basement.
So there are certain programs that will consider that when they qualify you, consider that you're being able to rent a portion of that.
It makes it easier, right?
Yes, because
if you're buying a house, I think I'm good now. I'm good, man. I'm gonna buy a home. Well, so now if you're buying a house with a basement that you can rent out to other people, the loan company sees you as a better fit than someone who's buying a home without a basement.
Well, so when they consider your income, your capacity,
Okay.
right, that auxiliary or that I'm forgetting the term, but that part of the house that you can generate rent income for will be considered as part of your income to qualify for that.
Ooh,
for that.
okay.
So it depends on the program. Speak with a mortgage professional, explain your situation.
Yeah.
Talk to them about what you'd like to do. Now, those homes may not be easy to find, but they're out there. Again, it's talk through the scenario with a mortgage professional.
Okay.
And a lot of times you'll find mortgage professionals who are not that interested in working with somebody. But there are a lot of us who are interested in listening to your scenario so that we truly understand what your needs are, and we're prepared to address them.
And one thing I kind of see also, it seems like people are afraid to even talk to someone thinking that they will reject them. And as you talk right now, it seems to me that the loan company is more eager to loan the money to the person than they want to get the loan.
So if you talk to a builder,
Yeah.
the builder makes money by building homes. and selling
Okay.
them. If you talk to a lender, the lender makes money
By lending money.
Lending money.
Okay.
So the more qualified people there are out there, the better it is for the loan company.
Yeah.
And what happens is, let's say you're rejected because each lender is going to have certain requirements. You're rejected by a particular lender. That doesn't mean the next lender is going to reject your application or
Okay.
decline to offer to lend to you. So there are some folks some lenders who say that we don't go lower than 620 credit score. Then there are some who say, well, we'll do 600. We'll do 590.
Really?
Right.
Oh, wow.
And there are, again, it depends on your situation, and finding the loan program that fits your situation is the key. Take the time to explain your situation to a lender.
So do you have access to different lenders?
Well, right now, I don't personally have access to different lenders, but there are brokers. So there are a number of participants in this business, in the mortgage industry. You have brokers who have access to a number of lenders. So when you go to a broker and sit and explain your situation, they may be able to find you a loan program that fits your situation. There are banks. There are credit unions. There are independent mortgage companies. So a lot of different lenders have different requirements, and they're all eager to find qualified people to extend loans to.
This is good. So as you plan about buying your home, one thing I want you to do is to start saving money. But by saving money, you need to know how to save your money. You need to get yourself an IUL, Index Universal Life, and this is what will help you do. You save your money inside of the IUL as you prepare to buy your home, and inside the IUL, your money will be growing for you, and then that prepares you to take a loan against the IUL and then go ahead and make the closing costs payment.
That sounds good.
That's a play, man. That's good.
That sounds good.
That's powerful, man. Man, this is a master class, bro. You cannot hide this information from people, man. They will charge you. That's not right. That's not fair. You have all of that information, man. You got to share with people. Right. So what else can you share with the people, man, so they can go out there and start buying homes?
If you own a primary home, you own your primary residence, you're able to become now a real estate investor, where you can start. There are programs where you can start buying homes for rental. There are programs where you can purchase a home, flip it, and sell it.
Mm-hmm.
Let's get the primary home, primary residence. Become a homeowner. And once you become a homeowner, let's move to the next stage, become a real estate investor.
So there are programs out there where you can get money to buy home and flip it?
Yes, there are lenders, and these are non-QM. This is
Okay.
not the non-qualified.
Non-qualified, yeah.
Right. So there are lenders out there. They exist solely to cater to the real estate investor.
Okay.
So what they'll do is there are loan programs where you can purchase the home. It's a home that needs work.
Mm-hmm.
They'll lend you money to purchase the home, lend you money to rehab the property, and place it back on the market and sell it.
Sell it, you pay
Once you
them
sell
their
it,
money back.
you pay them back, and you keep your profit.
But they say it's hard to find loans like that, like hard money lenders, right? That's what they call.
It's not hard at all. It's not hard at all. Again, lenders are eager to lend.
Okay.
They're rushing to find folks. They want folks to rush to their doors. But a lot of people do not know that. They think that the lender is stingy with their funds.
Mhm.
No, lenders would like to lend their
They
money.
want to lend you the money.
It's just a matter of managing risk, making sure that when they lend to someone that it's a good investment.
Okay.
It makes sense. The risk is worth it.
That's powerful.
But
That's
otherwise, lenders, they want to lend. That's what they exist
man,
to do.
I want to get something to flip. I want you to help me with that, man. I want
That's
us to,
very possible.
yeah.
We can definitely talk offline.
Yeah, man. I need to start flipping some houses, man. Yo, that's good. That's good. Mo, man, this is good, man. Thank you so much for coming on the show today, man.
Thank you for allowing me to participate, to speak to the folks on this platform. It's been great. You are extremely encouraging. And this experience is new for me. And I have to say that I definitely enjoyed it.
You killed it, man.
Definitely love participating. And I hope that one day you'll have me back.
You'll be back, man. People will have questions. People are going to have questions. All right. So any last word you want to share with the people before you leave?
I would say be encouraged. If you're renting, you don't have to be a renter for the rest of your life.
Okay.
You can start purchasing and start taking action today. Don't wait till tomorrow. Remember CIA. Take action. Look at your credit. Look at your income. And start building some assets.
Excellent. And as you buy your home, you need to know that you need a mortgage insurance, okay? Just in case something happens to you, you don't lose the money that you paid to buy your house. So whenever you need things like this, talk to me. Go talk to Mo first, okay? Don't talk to me first. Talk to Mo so you can get the house and then come to It's Possible Insurance and Financial Services so you can get your insurance and financial services. Mo, man, you've been really powerful. Thank you very much for coming to the show today. Everybody, thank you very much for watching this video. Hope that you like it and leave your comments, subscribe to the channel, and I'll see you next time.